Today, we are going to master the RAMP framework risk approach, materiality, and procedures. Specifically, we are going to break down the exact four-step response structure that scores the top marks. Let's dive. Step 1 is assessing the risk of material misstatement or RMM at the overall financial statement level. What exactly is an OFSL risk? It is a pervasive risk that affects the financial statements as a whole, not just one specific account. To score perfectly, you must use the winning exam formula. Never just state a risk, you must write 1. The case fact. What actually happened? 2. The risk factor. Why does it matter? 2 statements. And 3. The implication. Conclude if this increases or decreases the overall risk. Let's apply this formula to management and environment triggers. Our first trigger is the management bias. If your case fact says the bonuses are tied to net income, the risk factor is that this creates a strong motivation for management to overstate revenues or understate expense. The implication OFSL risk increase. Another common trigger is a high turnover. If the CFO resigns, the loss of institutional knowledge increases the likelihood of uncorrected mistakes. Again, OFL's increase. Moving to part 2 of management risks, watch out for the first time audit. If the company has never been audited, opening balances haven't been verified, and the team is unfamiliar with audit requirements, risks increase. Also, look closely at the tone of the top. If the management has a history of overriding controls or ignoring auditor advice, this demonstrates a lack of commitment to accurate reporting. OFSL risk increase. Here is a major exam trap. Candidates often forget to identify factors that decrease risk. If the case mentions an active independent audit committee, that is strong governance. This provides strong oversight and reduces the chance of fraud. Therefore, OFSL risks decrease. Similarity, if the accounting team is highly experienced and stable, that their familiarity with the business reduces the operational errors, risks decrease. Now, let's look at the business operation. A classic trigger is the implementation of a new IT or accounting system mid-year. This creates a high probability of data migration errors or a temporary loss of the audit trail. Risks increase. Rapid expansion is also dangerous. Opening new branches or acquiring competitors strains the existing accounting capacity and introduce complex consolidation issues, risks increase. What if the company enters into complex or unusual transactions like derivatives or foreign currency? The accounting team likely lacks the specific experience here, leading to valuation errors, risk increase. Lastly, for operation, watch for new strict industry regulations. This increase the risk of unrecorded contingent liabilities or fines for non-compliance. Risks increase. Our final category of risks involves the financial reporting. Pay close attention to debt covenants. If the company is close to breaching a bank requirement, there is severe pressure to misstate assets or hide liabilities to stop the bank from calling the loan. Risks increase. Going concern issues like severe cash flow shortages or losing a major customer also create motivation to artificial inflate financial health to secure funding. Risk increases. If the owners plan to sell the business or go public, there is immense pressure to overstate net income to maximize the selling price. Risks increase. Now, the most important part, the so what? If you conclude that overall risk is high, you must state the audit response, you must increase the professional skepticism assign more experienced senior auditors and incorporate unpredictability into your Step 2 of the planning memo is identify the user of the financial statements and debtors. Lenders and banks focus on liquidity and ability to repay debt. Shareholders focus on profitability and earning per share. Management focus on operation. The golden rule here is that the most sensitive user always dictate your materiality based. Step 3 is the audit approach. You have two options. The substantive approach means you rely entirely on GN testing. You do this when controls are weak or team is too small. A combined approach means you test internal controls to reduce your substantive work. You only do this when controls are strong and documented. Here is a common exam trap. If the key facts reveal a recent breakdown in control, you cannot use a combined approach. You must pivot to a substantive approach. Our final step is calculating materiality and performance materiality. First, to your base for for-profit companies yield roughly 5% of normalized pre-tax income. For not-for-profits or asset-heavy entities, just use 1 to 2% of total assets for revenue. Then apply that percentage to calculate overall materiality. Finally, set your performance materiality. This acts as the buffer for undetected misstatement. The AMM is a high, use a lower threshold like 60% to catch smaller errors. If risk is low, you can use a higher threshold like 75%. By following this structure approach, you will hit every key point the markers are looking for. Practice applying this formula to next case. I will see you in the next video.